Hi guys, welcome to my channel. In my 6 months ago, you enter into a currency forward contract. At the time, the contract had zero value. You didn't buy anything upfront. That sounds simple, but now 6 months later, market conditions have changed. Interest rates have moved. The spot exchange rate has moved, and the forward rates available in the markets is very different from the rate in your original contract. So here the questions. If you want to close the contract today, how much would it worth? And this is where two important forex concepts come together. For a word premium or discount and mark-to-market valuation. So let's start with the basic distinctions. The spot exchange rate is the exchange rate applicable to a near-term currency transactions. The forward exchange rate is the rate agreed upon today for exchanging currencies at a future date. So if I'm a company and I know I will need euro 6 months from now, I don't necessarily want to wait 6 months and discover what the exchange rate will be. I can enter into a forward contract today. That contract locks in an exchange rate for the future transactions, and the forward rate is usually worth in terms of forward points add to or subtract from the spot rate. Here's the key idea. The forward rate is calculated by taking the spot exchange rate and adjust it by the forward points. If the forward points are positive, we add them to the spot rate. The base currency is trading at forward premium, and if the forward points are negative, we subtract them from the spot rate. The base currency is trading at a forward discount, so the terminology is straightforward. Positive forward points is premium and negative forward point is discount. Forward point are related to the interest rate differential between the two currencies. Think about the economics. If two currencies have different interest rates, holding one currency versus the other generate different returns. The forward exchange rate adjusts for that difference. This is the intuition behind cover interest parity. You don't need to think of the forward premium or discount as some arbitrary Euler adjustment. It is fundamentally connected to the relative interest rate of the two currencies, and according to the curriculum relationship we focusing on, the larger the interest rate differential, the larger the forward adjustment. The adjustment also increase with the time to maturity. A 1 month forward and a 1 year forward don't generally have the same forward points because the interest rate differential has more time to accumulate over a longer horizons. From an investor perspective, forward premium and discount matter because they affect the cost of hedging currency exposure. Suppose you are a US investor buying a foreign asset. You may earn a return on the foreign investment, but your final return in US dollar depends on what happened to the currency. A forward contract can hedge that currency exposure. The forward rate therefore becomes part of your effective hedge return. So currency analysis isn't just about forecasting whether a currency will rise or fall. It is also about understanding the cost of carrying and hedging currency exposure. Now let's move to the second concept, mark-to-market value. This is where many students initially get confused. At the moment a forward contract is entered into, its value is generally zero because the agreed forward rate is set at the market rate. Neither party is giving the other an immediate economic profit, so there is typically zero initial value and no upfront cash payment. But that doesn't mean the contract will always be worth zero. Markets move, the spot exchange rate changes, interest rate change and therefore the forward rate for a new contract change. Suddenly, your old contract may be much better or much worse than what is currently available in the market. That's what creates mark-to-market value. Here's the easy way to understand mark-to-market. Imagine you want to close your existing forward contract today. You don't simply erase the contract. Instead, you enter into the offsetting forward position. If your original contract was a long position, your, offset, your offsetting position is short. If your original contract was short, your offsetting positions is long. The two positions cancel each other at maturity, but because the two contracts have different forward rate, there is an economic difference between them. That difference represents the value of your original contract. So step 1 E symbol. Create an equal and opposite forward positions. This is called the offsetting positions. The original and offsetting contract have the same contract size and maturity, but the directions are opposite. This allows us to determine what it would cost to close the original positions using today's market price. Step 2 is to determine the appropriate current forward rate. We calculate the current forward rate from current spot rate plus or minus current forward points. You must determine whether to use the peak or ash. That depends on the direction of the offsetting transactions. If you are effectively selling the base currency, you using relevant bid. If you buy in the base currency, you use the relevant ash. Okay, so net cash flow equal the difference between the current forward rate and the original forward rate multiplied by the contract size. The size depends on whether the original positions benefit from the change in forward rates. If the positions become more valuable, the result represent a gain. If it becomes less valuable, it represents a loss. But there's one more step. The cash flow occurs at the future settlement date. We want to know what that future amount is worth today. So we discount it back to the current day using the simple money market conventions in the curriculum. To market value equal the future cash flow divided by 1 plus the relevant interest rate multiplied by days over 360. So in other words, mark to market is the present value of the future net cash flow. Thanks for watching.